What's up, everyone? My name's Robbie. This is Robbie and Mila, and today we're talking about Disney. So, quick little shout out to Fernando Grassa for the idea to do Disney stock. So, thank you for leaving that comment. So, first, I don't even know exactly what to call my stock ranking system yet. I'm still trying to figure it out. Put a little poll up there, and it looks like people liked Cat 5. So, I might throw another poll up there if I come up with some other ideas. But right now, I'm going to call it Cat 5. So the Cat 5 or Cat 5 score has 5 categories, and the first category is what I call the Rolex score. This measures the quality of a company and the trust of a company. The next thing I like to look at, the industry-based valuation. After that, I go over the industry-based profitability. Then I go through the industry-based growth, and finally, I look at the liquidity score. After that, I'll go through a free cash flow, maybe EV, EBITDA, maybe even price to sales, but probably not on Disney, probably not a type of company that we need to do that on. And then after all of this, we're going to go through some technical analysis. We got a lot to go over. Let's go ahead and get started. So let's go over a very quick rundown of what Disney does. I'm sure you know what Disney does. You've heard of the company. We'll do this in 1 minute, one quick minute for what we're going to go over on the description. So the Walt Disney Company, together with its subsidiaries, operates as an entertainment company worldwide. It operates through 2 segments: Disney Media and Entertainment Distribution, and Disney Parks, Experiences, and Products. The company engages in the film, episodic, television content, production, and distribution activities, as well as operates television broadcast networks. So they have ABC, Disney, ESPN, Freeform, FX, Fox, National Geographic, Star Brands. They also have production companies. So they have Walt Disney Pictures, 20th Century Studios, Marvel, Lucasfilm, Pixar. Some very good, big, great studios that crank out some, of course, amazing video, amazing content, amazing movies, amazing television shows. And then we have Disney Plus, of course, which is a new big thing for them. We have ESPN Plus, Hulu. We have Star Plus. So these are some of the different segments that Disney operates in. It's not only just parks anymore. There's a lot of different things in terms of content and in terms of networks. So let's start off with the Rolex score. And the first thing I look at within the Rolex score is called Piotroski F score. What do I like to see with Piotroski F score? Well, a 9 is the highest F score a company can get. So if a company has a 0 to a 4 F score, they don't get any points. If they have a F score of a 5 or 6, they get 2 points. And if they have a 7 plus, they get 5 points. So let's go ahead and see the Piotroski F score of Disney. So Disney has a Piotroski F score of a 7. That's great. So let's take a look real quick. They don't have a higher current ratio year over year, and they actually have less shares outstanding year over year. So those are the 2 reasons they got deducted 2 points. You can get a 9 is the best Piotroski F score. They got a 7. Those are the 2 points they were taken off. So coming back here, we're going to take a look at shares outstanding, and then because it's increasing, that's not good. So we're also going to give Disney a deduction of points because of that as well. So basically, Disney gets a 5 out of 5 for Piotroski F score, which is the best you can do. And then they're going to actually get a 0 because they have increasing shares, which I don't like. And that is a score of 50% for the Rolex score of 5 out of 10. So next thing we have an industry-based valuation. So what I do here is actually I use a decile system now, which I'm going to explain to you really quick so you know what that is. I've gone over this in other videos, so I'm just going to do this really quick. So basically the decile system that I'm using is I try to find all the different PE ratios in the industry for PEs, price to sales, and so I put them into deciles. So what does that mean? Take a look here. This is the PE ratio of just an example of an industry, the construction supply industry. These are all the stocks PE ratios in the industry. There's 38 companies. And as you can see, the PEs are kind of all over the place. So after this is when I go ahead and I sort all the different PEs from smallest to largest. And take a look here. You have some of these really big PEs at the bottom, 88, 90, and 8,470. So if you took the average PE of just this entire industry, you're going to have a very high average PE because of this weird, crazy WNC corporation, whatever that is. So that's really driving the average up. So what I do is I turn this into a decile system. And so I group them all into deciles. So what's a decile? So the first few stocks are in decile 1. If you have a PE of 1.43, 8.03, 8.94. If one of those companies was the companies I was looking at, it's in the first decile. Next is second, third, fourth, fifth, sixth, seventh, eighth, ninth, and there's 10 deciles. So what I'm trying to do is find the cheaper stocks in this whole thing, and that is going to determine how many points it gets. Cheaper companies are going to get more points. So how we rank this is if you're in decile 8 or above, you get no points because you're really expensive. If you're in decile 5 to 7, you get 2 points still, and if you're in 1 to 4, you get 5 points. Let's take a look and see where Disney falls into the deciles. So we're going to go ahead and take a look here, and we can see here that 84.76 is Disney's current PE ratio. It's very high. And so now we're looking at the deciles of the entertainment industry. That's the industry that we have Disney in on this one. So 84.76 is the PE ratio. That's going to be in the highest decile. So Disney's, it's very expensive in terms of earnings. Now, there's some reasons because of that, but we're going to move on and we'll describe certain things later. But still, it's high. It's a very high price to earnings ratio, so they're not going to get any points on this. So decile 10, and their score is 0 in terms of price to earnings. Let's take a look at the forward price to earnings. Now, this is a little bit better. So if we're looking at the decile in this one, now we're looking more at a decile 6. So that's definitely going to get some points. So 25.80 and more is going to be decile 6. So here we go. We're going to add that in here. Decile 6. Remember, a 5 to 7, you get 2 points. So Disney's getting 2 points here for being in decile 6. Next is the price to sales ratio. So over here we have a 3.68 for the price to sales, so that's not too bad. Let's go down here and see where that falls. So we're in decile 6 again for the price to sales ratio, so that's pretty good. Let's go back, decile 6, and you get 2 points for being in decile 6. Next we have price to free cash flow. Let's go and see how this is looking. So Disney's price to free cash flow is very high. It's actually 180.96. That is actually not in the highest decile, interestingly enough. But it is in the 9th decile, so it's not going to get any points on that one as well. So let's go ahead and put a 9 here. This is actually wrong, 180. So how does Disney do in a industry-based valuation? It gets a 20%, so 4 out of 20 is the score for Disney. Let's go down and see how their industry-based profitability is looking. And so we're going to first look at gross margin. Same thing, we're looking at deciles. So let's take a look at the gross margin. So the gross margin decile, Disney is in 34.30 is their gross margin. That is in the 8th decile. So that's actually not that great compared to its peers in the industry. Let's go over here. 8th decile, 0 points. Next, we're going to take a look at net margin. So the net margin is 4.20. This one actually is doing pretty well in terms of deciles, so it's actually in the 4th decile. So Disney's going to get a full score here, so a 4 for the net margin. So Disney's actually doing pretty well here, so it's decile 4, gets 5 points for decile 4. And so the peer profitability score is a 50% for Disney. Next up, we have the industry-based growth. So we're looking at 5-year compound annual growth rate. We're going to start with revenue. So sales, aka revenue, are 3.90 for the compound annual growth rate. That is going to fall into the 6th decile. So Disney's going to get a little bit of a score on this one. So we got a 6, and it's going to get 2 points. Let's take a look at the earnings per share. So EPS growth over the past 5 years, negative 28%. No good. Now, how bad is that in terms of deciles? Well, it looks like it's in the 8th decile in terms of earnings per share, so not going to get any points there. So decile 8, 0 points. So next we have free cash flow. What is the free cash flow for Disney? So in terms of free cash flow growth for Disney, it's been a kind of tough few years for the company. So basically what's happened is they had acquisition, there was COVID, there's tons of kind of like negative things that happen with the company, but it seems like it might be taking a bit of a turnaround coming up soon. I think that projected in the next couple years, Disney's going to do a bit better than what they've done the past probably 3 years. But in the terms of the past 3 years, there's only been a 4.04% compound annual growth rate for the free cash flow of Disney. That's not good. As you can see, the free cash flow back in 2018 was 9.8 billion, and then you have free cash flow now of only 1.9 billion. So huge difference, definitely down a lot over that time period. These are not good signs, so I'm going to give it 0, but I do think Disney's probably, considering how great a company Disney is, I think they will definitely turn around the free cash flow. Just put a 4% score of 0 because we like to see a 10% or more for free cash flow for Disney. So that leaves us with an industry-based growth score for a 5-year compound annual growth rate of 13%. Let's go down to the next one. We have liquidity. So for the liquidity score, what I look at is the debt to equity ratio. I like it to be more than 2 essentially, so that's my preference. So the industry average we don't use on this one. Just put a little dash there, but we do use, of course, the actual, which is only 0.6, so that is good. So they're getting a 5 on this. So for liquidity, Disney is getting a 100% liquidity score. That's pretty good. So what is the total Cat 5 score for Disney? Let's take a look down here. So for Cat 5, Disney scored only 21 points. The total possible is 60 points. So the total score for Disney is 35%. Definitely under the 70% threshold that I like to see. We'll see what happens with Disney. You have to kind of have faith in the management because they've always been able to crank out great revenue, great cash flow, grow the business, make strategic acquisitions, things like that. So let's go ahead and take a look now at the free cash flow based discounted cash flow. Now, if Disney actually paid a dividend, we would have gone to that part, but they actually don't pay a dividend anymore, so we're skipping that part. We're going over here to the discounted cash flow. So what do we have? Well, let's take a look first. I'm on gurufocus.com. Free cash flow. What do we have? So unfortunately, over the past 10 years, Disney's free cash flow has declined by 4.8%. So okay, that's not good. It's going to be essentially very hard to do a discounted cash flow with a negative cash flow. So we have to kind of make a decision. So do we think that Disney is coming off a low base, let's say, and maybe they have the ability over the next maybe 10 years to really compound cash flow at a decent rate? So I'm going to say, what if they can do that? Well, let's go with a 15% growth rate over the next 10 years. So I'm coming down here, I'm making this growth rate 15, and then I'm going to see if I can also, I usually will use a little bit of a higher discount rate. So a 9 for discount rate, we have 15 here. We had free cash flow before of 1.09 is what I had, so let's go with 1.09 here. And as you can see, Disney is only worth $29.33 in this scenario, which means that it's crazy overvalued because it's currently trading at $145. So here's the thing about Disney. Disney is a very, well, I'll call it a bit of a unique situation. Its free cash flow is abysmal lately over the past 3 years. But if we go back, let's go back to, let's say, 2018. Its free cash flow was around 6 free cash flow per share. So suddenly, free cash flow per share being a 6 gives us an actual fair valued stock if Disney grows at 15%. Now, we have to kind of go back and say, what will happen? What do we really think is going to happen in these different scenarios? Disney has to get to a 6 first, and it has to still grow 15% from there. Do I think it's possible? I don't know. I just don't have a lot of confidence in this right now to invest in it. Now, if you thought this was going to happen all day, this could be an okay stock to buy. You might actually think the free cash flow would go up to a little higher, let's say a 7, and then suddenly you're looking at a decent margin of safety for the stock, $188 in fair value. But again, it needs to grow at 15% compounded. It's lost money in free cash flow, its free cash flow has been negative over 10 years. So things that, glaringly don't look very good, but if you do look back to 2018, things were okay when it was growing. So it didn't look so bad back then. So a little tough one for me to kind of digest. Let's take a look, instead of just doing a discounted cash flow, let's take a look at an enterprise value to earnings before interest, taxes, depreciation, and amortization, which is EV to EBITDA. Let's do a valuation using that. So what I'm doing here is basically I'm forecasting the EBITDA of Disney first, and I'm also forecasting how many shares are going to be outstanding. So we take a look here. Disney had been basically increasing shares quite a bit because, financial things going on, COVID, things like that. I'm assuming that's why they were issuing shares. I haven't looked into that, but I just know they are. Now, before that, over the past 10 years, they really haven't issued shares. They haven't diluted you over 10 years. But recently, over the past 3 years, they have. because, things haven't been so great for, I guess, the company since about 2018. So then the question is, what do we do here? Do we continue diluting this or do we not? So honestly, let's go with, instead of 1.5% dilution, let's say it's 0. What if Disney does not dilute you at all? They don't buy back any shares, but they don't dilute you. So that's the first kind of assumption we're going to make here. The next thing we're going to do is we're going to figure out what EBITDA growth is. So if we look back, and we can see here EBITDA in millions. So 10 billion was their EBITDA back in 2012, which grew in 2016, 2017, 2018. It continuously grew, basically. And then, so the question is, what's that rate of return? So we're looking at an EBITDA growth in that time period of about 8.61%. So let's go ahead and say, what if that was to occur? So let's do 8.61 here. And so now we're growing Disney's EBITDA at 8.61% going forward until 2026. And so here we have EV to EBITDA with the multiples of EV to EBITDA. Now let's take a look at the historic EV to EBITDA multiples. So 2017, 10.21, 2018, 10.71, right? So lower EV to EBITDA. 2020, 51, 2021, 38.37. The average is 25, but the median is 14. So now we have to decide, okay, what multiple are we going to use here? Because the multiple is going to help us figure out what the price of Disney maybe should be. So in this column, you have a multiple of 10, EV to EBITDA of 10. Brings us to $44.52. But what if it's up closer to the current EV to EBITDA, which is 35? Well, now we're looking at 155 as a stock price. So essentially, this is just a pivot table of different ways to get to this number. We're looking at 2022 with a 10, 15, 25, and 35 EV to EBITDA multiple. Then we have all the way out to 2026, what that would be. So for example, if you bought this stock, Disney, assuming all of these different assumptions we've made, the stock would be worth $216 in 2026. What's your average rate of return? What's your compounded annual rate of return if you did that? So the answer is it's 8.25% in 2026. So if you bought Disney now, you held it until then, it has a 35 EV to EBITDA multiple, you would make 8.25% on Disney. Now, remember what we needed to do to get there. We had to do some things that I don't know if I'm very comfortable with the things we had to input for this. So what if Disney also, when things kind of got better for the company financially, what if they started buying back more shares? So if we do that and let's say, they buy 2% back every year, we could see what happens with the stock price. And, it's looking a little bit better. Now we're looking at about a 10.46% rate of return at a 35 EV to EBITDA multiple. Again, if it ends up being like the normal historical multiple it was back in 2015, 16, 17, we're looking at a negative 53% for Disney. So I don't know if I would want to invest in this given the price of free cash flow, but if we want to use these two to kind of find a price for Disney, let's go ahead and do that. I guess what I'll do is I'm going to be really aggressive with this one. Let's give it the benefit of the doubt with a 35 EV to EBITDA multiple, which would be $159 stock price. So what we're doing is we're kind of taking an average of these two. Let's just do 50-50, and let's take the price of free cash flow, DCF, that we had. So if you remember, we did about a 9% discount rate. We said 15% growth. Disney gets turned around. Things get better. Then we had a margin of safety of 22.55% and a stock price of 188. This is also aggressive. So we're being aggressive on this. I don't necessarily think this would happen, but now we got 188, 50-50, and the stock value should be $174 if we went by this valuation metric. Again, I'm very skeptical about using these numbers. They're very aggressive. Would I probably do this? Probably not. I would want to really hone in on those different growth rates. I do a lot more research to see if Disney is going to be able to accomplish that anytime soon. Now that I think about it, I think we should also kind of mention what the lower bound would be. So the lower bound, if we went back to Guru Focus, because I do want to make sure that we don't say this is super aggressive. What if we go with a normal, let's say free cash flow growth rate of, let's say, 10%. But we also had the free cash flow not starting off of a giant base, which is nowhere near. But what if we use the current like free cash flow, which is like 1.09? So let's go with even a little more aggressive. $2 per share, free cash flow per share. What's that do? Well, we have $38 as Disney's target price. So let's throw that in here. So now we put 38 here. $99 is Disney's price. So again, it's varying on this company. It's really going to depend on what you think of what's going to happen with turning it around, growth rates going forward. What's going to happen with Disney Plus? Is it going to be profitable? Will they be able to increase margins? Anyway, let's take a look at the technicals. Let's not get too complicated with the technicals today. So basically, RSI declining, MACD starting to potentially turn over. Actually, this looks like a divergence, so that's that's interesting. We definitely have some resistance in this area, so let's take a look. Where is this resistance? Maybe around here, we could say definitely resistance. So it's having a hard time getting above the 158, and then we could do this a little closer here. 156 to 158, definitely lots of resistance. There's maybe some a little bit of a support in this 200-day moving average. That could be helping a bit, but you have a 50-day moving average above it. We had a gap here. They say gaps get filled, might go down lower. Even if it does get up to this area, there's also some resistance that's pretty big here. That's 100 and let's say 70 area. So that would also hinder potential increase in the stock price. I think potentially Disney could be going back down, and I would watch the probably 128 area to see what happens around that area if it does go down. So what you could say is, let's say Disney goes down to 128, take a look, see if there's a little support area there. If it bounces, comes back up off 128, maybe that's a potential place to buy it. Figure it out on your own, do your due diligence. For me, I wouldn't buy this company right now. I'd wait to see if I was more comfortable with what I understand about their future of basically growing the free cash flow, getting that going, and having growth come back in the future, maybe help with their margins, things like that. So anyway, thanks for watching. Hope you liked the video. Hit that like button, subscribe, see future content like this, and watch another of my videos coming up on the end screen right now.